Howdy, Jacob here. Today we're looking at Dutch Bros. It is a coffee business founded in 1992. I didn't realize that. So they operate franchise drive-through shops in the U.S. I've seen them pretty heavily on the West Coast, and they just put one pretty close to my house here in Tennessee. 7.3 billion market cap, 7.3 billion enterprise value. It's not usually the business that I like to review because not a lot of history here. So there's really, if you have history, it's easier to create assumptions because the business has shown what they've done. However, when you don't have those type of numbers to go off of, you're really shooting from the hip, creating a story of what you think they can do, and you're just going to have to put on an extra margin of safety, whether that be the discount rate or your assumptions, to be comfortable with. And so for when we get there, we get there. But here we see declining gross margins. I don't like to see that. But revenue growth is astronomical. They're still heavily reinvesting back in themselves, which we see by them having a negative operating margin usually, and then no return on invested capital. Their income statement shows cost of goods sold increasing like crazy, sales general admin also increasing like crazy. So really, they're still just a growing business, growing shares pretty heavily. Balance sheet shows 134 million cash on hand, 4 million short-term debt, 93 million long-term debt. They are capital leases of 559 million. Makes sense. They are in the kind of retail space. I mean, they own build or they operate built within buildings, so I guess that does make sense. But in relation to short-term, long-term debt, they have enough cash to write that off, so we're not concerned with that. The cash flow statement, they're just reinvesting. They're creating a lot of Dutch Bros around the United States, and so we see that in their capital expenditures. They're just um, creating stores, and it just hasn't quite hit their cash from operations yet. So they haven't necessarily, all their growth hasn't really hit the bottom line yet. And so maybe we have to look at a Starbucks to see what their type of margins are to say, to kind of create our story to see whether that's possible for them is a different, a different idea. But let's look at that quick. Let's see what their margins are. They have operating margins pretty high, free cash flow margins. Um, we're looking at a 5-year average of, let's say, kind of all over the place, but $3 billion, $3 billion. Okay, so we're looking at about 10%. So maybe on the high end of Dutch Bros in 7 years, they're at 10%. But realistically, that may seem like a bit of a stretch, and I'm always here on the conservative side. So I think revenue growth side, they're reinvesting so much, they could easily grow 15% a year for the next 7 years. And then to be a little bit conservative, but give kind of a range here, maybe let's do 4 and 8% just to see where the numbers kind of flow. The share change, probably just stock-based compensation, so $30 million. But they have issued a bit of shares to fund some things, so maybe let's look at history. Let's do 1% increase would be about 70 million. 2%, 140, 180. Okay, let's do 2%. That seems pretty reasonable to me. Or with stock-based compensation, 2.5. And then PE, I mean, even at the end of 7 years, they're still probably going to have some growth ahead of them. Is 22 small? I mean, definitely, maybe. Um, and then here, maybe I want a 17.5% return because I just don't know what's going to happen. So I just increased the margin from 5 to 10, and even on the 10 side, you have a 24 price. Current price is $42 a share. So even creating a story that they have margins similar to Starbucks, they can grow 15% a year for the next 7 years. Maybe they grow greater than that. I mean, the last 4 years they've gone 37%, 52, 48, 30. But I always err on the conservative side, even when I'm trying to create a story, because I don't want to. Everything isn't always roses. Business is not easy, and so I do think I'm comfortable with these assumptions. We're saying the company stock price needs to fall 64% still before you get the return we're looking for. But you know, I do think that they could create a business similar-ish to Starbucks, kind of compete. But to me, I think Starbucks already has the position to where it's the most dominant. And I think Dutch Bros is just trying to do their best to compete, but they're from a business perspective, they just don't have the margins. But they're still heavily growing, so we'll see where it goes from there when they become more of a established business with not a lot of increased stores around the world or restaurants or whatever coffee place, I guess coffee place around the world. So I do hope you enjoyed the video though, and have a great day. Thank you.